I went to Stanford for undergrad and actually got into tech originally as a writer. I was the first reporter to cover Snapchat and DoorDash. Are there any indicators of product market fit? We are solving a fundamentally different and in a lot of ways easier problem. And we really increase your odds of being in one of the winners from these firms.
From your seat, what are you seeing on the current state of play in VC and startups generally?
How can we use the latest tools to deliver our mission in an even more compelling way to our users without sort of having shiny object syndrome and changing your roadmap every 6 months because OpenAI or shipped a new feature? We're moving away from this sort of ping pong tables and kegs of beer era into the, really understanding and get the most out of equity.
Hello, and welcome to another episode of the official CF Div Sweeps podcast with me, your host, Rory. We've gone virtual and we've gone off camera this time due to a number of technical difficulties, but hopefully a good show nonetheless. We have Ken joining us from Hong Kong and a special guest, Billy, all the way from America. Billy, you're the founder of Prospect. It's good to have you on the show.
Yeah, thanks for having me. Excited to be here.
Yeah, no worries. Ken made the introduction because obviously you two have sort of business ties together. And really excited to learn more about what it is Prospect does and probably a wider sort of breakdown of the VC startup landscape.
Definitely. It's exciting times right now.
Look, correct me if I'm wrong. I've been doing some sort of reading on Prospect and talking to Ken. It seems that Prospect really helps potential employees choose which startups to work for. And it's got a number of quite cool tools, one of which, helps them sort of calculate what their equity could be worth. And I've also read about a sort of proprietary model which scores startups. So I wondered if you could just touch on that and also perhaps your personal journey in terms of when you were first looking to get into the startup world. Apparently you took a very sort of VC approach in how you went about it.
Yeah, absolutely. At a high level, if you think about the VC side of the cap table, LPs have a GP layer to help them make better decisions. We've spent billions of dollars and a bunch of smart brains, improving outcomes and decision making when a VC is going to invest in a company. But when you're an employee taking a below market cash salary and a lot of your compensation and equity, you're also making an investment. And think that employees really need a better guidance layer. Now they can't afford to have, the GPs at Sequoia guiding their decisions, but software and a machine learning model can help them in an enormous way. And that's Prospect. That's what we do. As you kind of alluded to, I'll give you a little bit of background on sort of where this idea came from. I went to Stanford for undergrad and actually got into tech originally as a writer. I was an intern at TechCrunch while being a student. I was the first reporter to cover Snapchat and DoorDash. Graduated and joined the investment team at Khosla Ventures. So I was on the VC side of things for a couple of years, learning the ropes of investing and evaluating companies. Actually left Khosla when I got a book deal, tried a book about Snap. So got to cover that company from idea to IPO, kind of thought of that as the first consumer product I shipped and had to think about, how do you get people to buy books in this century? And then the earliest version of Prospect was a job search I did. In 2018 was graduating from Stanford Business School and knew from working at Khosla that the right way to do a startup job search is to think like an investor. And so spoke with a bunch of friends who are VCs, came up with a short list of companies, was looking at Airtable at the Series A, Fair at the Series B, Lattice at the Series B, a few misses, Quibi and Atrium on there, and ultimately joined Rippling before its Series A. I was there for 3.5 years as we grew from 30 people to 1,000 people and kept seeing this sort of same problem over and over again. We were recruiting folks into Rippling, people joining and trying to understand what their equity meant and what to do with it. So it really just felt like this was a really burning problem in our industry and something I was excited to tackle. And so left to start Prospect, and here we are.
That's an amazing sort of background. So you were sort of screening these companies, obviously before that, obviously being the first on Snapchat and DoorDash is quite a hit list, but you were sort of screening these companies and it was Rippling that you decided to go for. You said you're sort of employee 30 and were there to 1,000 people.
Yeah, exactly. And it's actually funny. Some of our other investors, Rachel Holt, now at Construct Capital, previously at Uber, and then Chenli Wang, now at WonderCo, previously at Dropbox, both also sort of joined those companies, Uber and Dropbox, around the same number of employees, between 20 and 35 ballpark. And sort of think there's this interesting sort of shared spirit we have that we were early, but at a point that there was an inflection point you could see, and it's not a spins of a roulette wheel. There is something sort of tangible you can glom onto and see, hey, this has real potential. I should join.
And so, were there any other lessons in, I suppose, seeing this sort of similar pattern play out in companies where, so what you're saying is that employee sort of 25, it's de-risked. There's a future there, and then it's sort of safer to play for the equity upside. But were there any other lessons or sort of like markers that you sort of picked up on when you were doing this screening or looking at other companies sort of going through a similar journey?
Yeah, I think what you're really trying to do, there's a great Peter Fenton from Benchmark quote that I'll probably butcher trying to remember off the top of my head. But he basically says, our job is not to predict the future. It's to see the present as clearly as you possibly can. And so I think for a lot of these companies, whether it's Rippling, Uber, Dropbox, what you're trying to see is sort of two things, I think, broadly. One, are there any indicators of product market fit? What in these sort of current metrics, even just anecdotes from talking to customers, potential customers to understand the pain point, that lead you to believe the company is at sort of the first step of product market fit. And you're sort of, you want to basically be as early in that, the start of that hockey stick curve as you can be. Then I think the other is talking to these founders, understanding their vision, why they're the right founder to solve the problem. Talking to Parker, he had such a clear vision for what Rippling would become. The strategy today is largely the same strategy he could articulate very clearly back in 2018. So those are a couple of things that jump out to me.
That's a good point. I like sort of being as early on the hockey stick as possible. That sounds like a very, very good way to maximize your personal upside. But like you say, it's, you are in some sense, you are a VC with your own career. So if you're going to bet on these startups, it probably helps to make it as sort of rigorous a process in choosing them as possible.
Definitely.
And so maybe that brings us on to just exactly what Prospect is today and perhaps a bit more on the problems it solves.
Yeah, for sure. If you think about some of the most data-driven venture firms, Cotu, Tribe, Signalfire, a lot of investors have data scientists, machine learning engineers on staff nowadays, building models using a bunch of different data sources, everything from, other investors and the fundraising history of the company to the background of the founders. There's a bunch of sort of a burgeoning world of alternative data where you can get everything from web traffic to app downloads to, people are getting very creative with how you try to find sort of interesting proxies for revenue. And you basically can use all these inputs to try to find what are these startups that have the highest potential. Then I think what's interesting for us is, we are solving a fundamentally different and in a lot of ways easier problem for employees than venture capitalists. If you're a VC and you spot a great company that you think is growing really well, has great backers, you have to sort of beat out Sequoia, Benchmark, some of these great firms to win the Series B. If you don't win that Series B, you have to wait and then pay a large markup to win the Series C. But as an employee, the whole reason the company is going to raise that Series B is to go hire 100 people who all get in at the same price as that Series B. And so in a lot of cases, we can look at a company and say, okay, they raised from Sequoia 18 months ago. In that time period, all of these different metrics we track are trending upwards. It seems like the company is growing really well. The company seems healthy. Things we track for sort of signs of the company going off the right path, no red flags there. Go join that company. And we really increase your odds of being in one of the winners from these firms. If you're familiar with venture capital, there's a power law that drives returns. And so a few companies will drive most of the returns of the fund. And so trying to think about different signals we can look at to see, hey, are you getting good odds that you're in one of the best companies in that sort of power law piece of the distribution? So anyway, long-winded way of saying we built a machine learning model similar to what you might see at the best VC firms, but rather than using it to be investors, we use it to help employees, make the best decisions and ultimately increase their earnings.
I wanted to actually ask. So, in the few conversations, kind of betting against these VCs in certain respect, depending on the model. Maybe the model's betting on it, maybe not you personally. But has that kind of led to any weird or interesting conversations with VCs in that regard? There's also the conversation that is of it being more of a art than a science, and putting that into the model itself. Has that led to any more qualitative conversations in regard to that?
Yeah, for sure. Yeah, definitely agree on the art and science blend there. That's sort of what I think is some of the magic of Prospect. So, coming from my background, spending a decade purely on the art side of things, whether it's evaluating Snap and DoorDash as a writer, evaluating a bunch of amazing companies like Instacart and Stripe. When I was investing at Khosla Ventures, I kind of bring the art to the table. And then one of my teammates, Ben, was a data scientist at Opendoor. He built models predicting home prices there. So they're version of the Zillow's estimate. And so we kind of do this mind meld of thinking through, okay, we'll literally sit side by side and look at, okay, how would I, evaluate this company if I was on the investing team at Khosla? What is the model thing, and how can we sort of bring the best of both worlds to the table? And train the model on some of those things and constantly adapt and get better. So yeah, it's definitely sort of a blend of art and science.
Obviously, at the end of the day, if you can have a model, you can refine it. And if you can refine it, you can sort of converge onto sort of systematically better decisions. Might be nice to compare what sort of taking a job pre-Prospect was like, and then perhaps what you think in 3 or 4 years' time when you've got Prospect fully up and running, what you think the sort of startup job market will be like.
Bunch of interesting threads to pull on there. I think in terms of the way things are different, when I was doing my job search where I found Rippling, part of the reason I was able to come up with a really strong list is that I had worked at Khosla, knew a bunch of investors at sort of the top firms, and so was in a really great position to be able to ask those people for help. If you have a similar sort of like amazing network, know everyone at sort of the top investors, this just saves you time. But think there's a much larger universe of employees, who are not investors. They're passionate about being an engineer or a designer or a salesperson, and they're not, just chatting with their buddy at Sequoia. And so for those people, I think it really makes the impossible possible, and brings this sort of knowledge that to date has sort of existed in private WhatsApp groups or people grabbing coffee in San Francisco, and really makes it much more accessible. And then broadly, if you think back to when I was first getting into tech, people would all be in San Francisco. You would go grab coffee with a friend, look at what a few different venture capital firms are investing in and pick a company. Today, there's been an explosion in funds, in types of funds, in everything from the rise of solo GPs, where now you have to understand that Elad Gil is an amazing signal, whereas previously you just had to sort of learn 20 venture capital firms' names. And then geographic explosion. We're sort of chatting across New York, London, Hong Kong. There's great startups everywhere. There's talent interested in startups everywhere. I think that trend is only going to continue to accelerate, as folks build amazing tools to sort of make productivity and connectivity better. And so I think the complexity has gone up by an order of magnitude and will continue to rise. And so, putting this sort of on autopilot and letting Prospect figure it out for you, I think is a huge benefit.
So this sort of, in some sense, is a further democratization through technology, right? Where people perhaps slightly less well connected or who don't have that network above them are able to access opportunities, and it should ultimately lead to a better labor market where labor can be allocated more efficiently, and hopefully therefore the startup ecosystem can become even more vibrant than it is.
Exactly. Yeah, we want to separate the how good you are at your day job at being that designer, being great at marketing, from how great your network is. Think that it's better for the employees as obviously more people have the opportunities to find and work at and get compensated in equity at the best startups. And then think it's better for the companies. If you have a broader pool of applicants, you can find top talent and recruit them into your company. So it's something we're super excited about.
And are there any other firms trying to tackle this problem in the same data-led approach you are?
Not really. There's a couple of folks that are thinking about sort of adjacent problem spaces and trying to help people figure out how much cash they should get in recruiting. Some folks take sort of we think of it as like a media style approach where they say, here's this list of, I think the CNBC recently had their Disruptor 50. It's always sort of, Forbes, CNBC, X, and then some big round number, the top 50, the top 100. And there's sort of static media lists where, if you're reading the list from 9 months ago, who knows how those companies are doing. But no, I don't know of anyone that's sort of taking the same accurate up to the minute, data-driven approach that we are.
And I really want to sort of drill down into that AI machine learning approach. But before we do that, just because a lot of our sort of viewers are interested in a wider or sort of macro picture of venture capital.
Yeah.
From your seat, what are you seeing on the current state of play in VC and startups generally?
Yeah, it's an interesting time. I think that sometimes people want there to be sort of a simple story of everything's going great or everything's going terribly. And we sort of see, very conflicting narratives. And maybe I'll break it into sort of, two worlds, AI and non-AI. And obviously, since we're just chatting on a podcast, I think I'm going to have to paint with a bit of a broad brush. But, broadly, what I think is interesting is within AI, you have real genuine innovation, companies that have amazing traction, companies that have amazing potential. Then you also have a ton of hype and overinflated, valuations. And I think in a lot of cases, people making the same mistakes they made in 2020 and 2021, where they're just, sort of deploying capital at prices that are going to eat away all their returns. And then, on the non-AI side of things, again, you sort of have two things happening at the same time. You have companies that are growing incredibly quickly, that are doing quite well, your Ramps and Andurils of the world that have product market fit, and we think are on a really strong path. And then you have companies, that maybe haven't raised since the downturn, on paper have a large valuation, but reality is much more complex and they're facing much stronger headwinds. And so I think that, sometimes folks try to paint with a broad brush and just say, it's either boom times or bust times, but reality on the ground is much more complicated. But it's definitely an exciting time. I think the energy across tech is really an exciting time, and I think it's overall a pretty healthy ecosystem.
Billy, that was a really interesting summary of the sort of landscape of VC and startups, and I quite like the fact it's almost separating into AI and non-AI. But on the role of AI in startups, it'd be really interesting to get your take as someone who's, not necessarily a PhD mathematician or computer scientist who's sort of building a business around this AI model and how you've gone about it, and also how important you think AI is in becoming competitive in this startup landscape.
Yeah, we try to be, very much on the lookout for what are the ways we can use this to, increase the ways we deliver value to our users. It's this kind of constant battle as a founder nowadays of not having shiny object syndrome and just going, hey, OpenAI launched all this cool stuff yesterday, or maybe it was 2 days ago. Let's totally pivot the roadmap and figure out how we can put a quick wrapper on this and get it out the door. And sort of sticking to what is our core differentiation, what is the way we see the world that is unique and that will become mainstream over time, but for now is a bit unusual. But then also thinking about, okay, what are some of the assumptions about the business that previously were not possible and now are becoming possible. And so just to give you one example from us, we kind of think of some of these language models as endless research interns for the long tail of startups. It would be prohibitively expensive to have 100 equity analysts on staff who are, reading everything that is written about, some of these small Series B startups, looking into every resume that mentions one of those companies to see if there's any interesting stats you can pull out of it. Looking into, a bunch of different text about how that industry is changing and where it's going. But obviously, if you can train models and use models to sort of extract some of those insights, it becomes much more affordable and scalable. So yeah, it's sort of this balance of how can we use the latest tools to deliver our mission in an even more compelling way to our users without sort of having shiny object syndrome and changing your roadmap every 6 months because OpenAI or Google or someone else shipped a new feature.
That must actually be quite a hard challenge to not get too caught up in the current hype of AI and stick to your knitting and sort of recognize which development is actually applicable to your business and not.
Yeah, it definitely, I mean, this is my first time being a founder, so it's hard to say compared to the past, but I would say, thinking about my time at Rippling, and then I think there's a great Steve Jobs quote about, again, kind of butchering one of these off the top of my head, but, thinking about how the number of good ideas you have to say no to, so you can just focus on the ones that are amazing. And that's kind of what I think about. I mean, at Rippling, we had so many things that were like, that's a great idea, super compelling. We're just not going to get to it today because we have this other opportunity that feels even larger. So I feel like as a founder, your job is kind of constantly being, one minute you're in brainstorming mode, we could do anything, we should do all these things. And then the next minute you have to, acknowledge resource constraints and ship quickly and chop things. So it's a hard time, but I think it's kind of always the case for a founder.
And do you have any advice for perhaps like a founder from a non-comp sci background who's looking to implement AI or trying to update their existing service to have more sort of AI involvement, or just generally update and tech proof their existing business?
I think it's one of the more interesting times to be non-technical because so many of these tools are becoming democratized. They're becoming so powerful. And so I'd actually say, something that I am broadly sort of interested in is the rise of sort of solopreneurs, folks of a small team that are sort of solving a niche problem, with these tools that are getting more and more powerful, seemingly on a weekly basis. So I'd actually say it's a super exciting time. I think you don't really want to get caught in the middle, where you don't want to be sort of the venture-backed founder that's, a wrapper on AI, or something that is sort of, marginally improving an existing service where, the next time they release an update, you could be wiped out. But I would actually say there's really interesting times to be using this in a defensible way. And then, I think that the sort of tools for those people that aren't technical have gotten way better, which is super exciting.
Yeah, I can see how if you're just a sort of marginal application of ChatGPT, then you sort of risk them developing the feature that you're sort of solving. One other question I wanted to ask you, I came across an interesting stat the other day that there's expected to be over 64 billion in transactions in private company stock. Now, I think this is mostly on sort of platforms online that allow you to trade shares in private companies. But I just wondered if you had any views on this rising liquidity, given that it broadly plays into your theme of investors sort of allocating their time and capital to these startups.
Definitely think it's broadly, kind of playing in the same space. And in a lot of ways, it's obviously the natural endpoint of the sort of equity life cycle. You kick off with recruiting, where you go join a great private company like Ramp, and then eventually you want to, sell some, buy a house, and over the longer term, sell all. Yeah, and we see this, peer to peer, sort of through secondary marketplaces, as you mentioned, and then we're also seeing a rise in company sponsored tender offers. Companies like Figma, Stripe, Canva that are planning to stay private longer realize that they have these long tenured employees that have 90% of their net worth in this one stock, or just have life events. People want to buy a house, need extra money to take care of a family member. Some of those life events that, really can't wait. And so we're really seeing this sort of, I think, evolving approach to liquidity and kind of seeing it as the ultimate employee benefit. We're moving away from the sort of ping pong tables and kegs of beer era into the, really understanding and get the most out of equity era. If you think about the original reason that startups gave employees equity, it was to make them owners in the business and align incentives. We see our role as helping employees cut through the noise and understand what that's actually worth. And then think it's a really positive trend for the industry that companies are taking it more seriously as well and saying, we should help these employees get liquidity when they need it. And so overall, I think it's very related to what we're doing, and we're excited about it.
And I suppose it's also a potential data point for you.
Yeah, definitely. Certainly when there's strong investor interest, in buying into secondary shares, that's usually a good sign that the underlying business is healthy. And so, in some of these cases, you don't want to over rotate. Sometimes people will take an employee sold 50 grand of this company at a kind of crazy price, and they'll say that's the new valuation. And we don't really put much weight on that. But there are ways to sort of use the prices, the demand as ways to understand, okay, how do investors think about this business? So definitely something we're interested in.
I know you've got to go in a couple of minutes, so I just wanted to ask you a couple of quick fire questions, I suppose, for our viewers who may be, in VC or trying to get into VC or just be entrepreneurs. But is there anything that you can sort of reflect on your journey or your insights from Prospect? Any bits of advice you'd give people either looking to join a new startup or sort of hone their skills as an investor in startups?
Yeah, I think joining a startup, I think now is a really exciting time to be operating and investing. I think in that sort of crazy hypey era, a lot of people just learn the wrong lessons. Whether it's trying to cut your teeth as an investor and you invest in a Series A, and 6 months later, some of those firms that shall remain nameless decided it was a unicorn, and you think this is easy, I'm a genius. And similarly on the operating side, I think some of the best companies maintain discipline and worked to sort of build efficient machines. But it's just very difficult when investors are throwing hundreds of millions of dollars and sort of stuffing some of these startups like their foie gras. And so I think it's a really healthy time to be building and sort of learning more lean muscle. I think if you're looking to join a company, shameless plug to use Prospect to find where you want to work. But more broadly, I think taking some of the principles we've talked about, thinking about you are going to commit 3, 4, 5, if it works out, longer. I have friends that have found the right startup, risen up the ranks of Rippling, that have been at Anduril for years, and I think will be there for the foreseeable future. And so, taking that decision seriously and really thinking about it with the same gravitas you would an investment.
Perhaps any advice for people in terms of managing their network? I know you're trying to disintermediate that in some sense, but it sounds like you really got the networking bit right, and that's something that we try and help people with. Any advice for people in terms of managing their network?
Yeah, for sure. Yeah, I don't see us necessarily disintermediating it. I think it's still super important. I think what we're really doing is more just making this knowledge more accessible. So you don't need to sort of have this stellar network before you can get your foot in the door and join a company and work hard and earn from the equity. But I think that networks are super important. I think broadly, the more you can sort of work with people on actual hard problems, help, whether that's working together side by side at a great startup to achieve a great outcome, helping someone with an investment. I think the more you can sort of be working hard on real problems versus, at a networking event, the better. But that's kind of I think it's super important.
Well, in that case, Billy, we'll let you run. For anyone interested in what you do, or perhaps looking to join a startup and are desperate to get insights from your model, where can people find you?
Yeah, definitely. You can check Prospect out. It's just joinprospect.com. You can follow me on Twitter. That's at Gallagher Billy. And then, email me if you have questions, if you're doing a startup job search and, want some helpers and pointers, or trying to figure out what your equity is worth, whether, it's a company you're thinking about joining or a company you already work at. I'm happy to help. So my email is just bgallagher@joinprospect.com.
Brilliant. That's a very kind offer. Thank you. And on that note, we'll end the show. Thanks for your time, guys. And see you next week.
Yeah, thank you so much. This was fun.